Before you even think about opening an investment account or downloading a trading app, you need to understand one fundamental truth. Investing is not about getting rich quick. It is about building wealth slowly, intelligently, and consistently over time. Most beginners jump in expecting immediate returns, but the market does not reward impatience. It rewards discipline, education, and emotional control. If you are here because you want fast money, this script will help you reset your expectations, and that is the first real step toward becoming a successful investor. The biggest mistake new investors make is skipping the foundation. You would not build a house without laying concrete first, yet people invest thousands without understanding basic concepts like risk tolerance, asset allocation, or compound interest. Before you choose a stock, fund, or crypto, ask yourself, do I know what I am buying, why I am buying it, and what I will do if it drops 30% tomorrow? If the answer is no, pause. Go back. Learn. This is not optional, it is survival. Your first investment should not be in Tesla, Bitcoin, or some trending stock your friend swears is the next big thing. Your first investment should be in knowledge. Read books. Watch credible financial educators. Understand how markets behave during crashes, booms, inflation, and recessions. Knowledge is not just power. It is your shield against panic, scams, and bad decisions. And unlike stocks, knowledge never crashes. You must also confront your own psychology. Markets go up and down, that is guaranteed. What is not guaranteed is your ability to stay calm when your portfolio loses value. Emotional investing is the fastest way to lose money. If you cannot handle seeing red numbers for a few months without selling in panic, you are not ready to invest real capital. Start small. Use simulators. Build mental resilience before you build a portfolio. Another critical step: define your goals. Are you investing for retirement in 30 years? A house in 5? Passive income in 10? Your goals dictate your strategy. Long-term goals allow you to take more risk. Short-term goals demand safety and liquidity. Without clear objectives, you will chase random opportunities, react to headlines, and end up with a messy, ineffective portfolio. Write your goals down. Revisit them often. Let them guide every decision. Emergency funds come before investments. Period. If you do not have 3 to 6 months of living expenses saved in a liquid, low-risk account, do not invest. The market is not a savings account. You cannot withdraw reliably during a downturn. If an emergency hits and you are forced to sell investments at a loss, you have defeated the entire purpose. Secure your foundation first, then grow. Understand that fees, taxes, and inflation silently eat your returns. A 1% annual fee might sound small, but over 30 years, it can cost you hundreds of thousands in lost growth. Choose low-cost index funds. Use tax-advantaged accounts. Rebalance efficiently. These boring details matter more than picking the next hot stock. Small advantages compound into massive differences over time. Diversification is not just a buzzword, it is your insurance policy. Putting all your money in one stock, sector, or asset class is gambling, not investing. Spread your capital across different asset types: stocks, bonds, real estate, cash, geographies: United States, emerging markets, Europe, and industries: tech, healthcare, utilities. When one area falls, others may rise. Balance reduces volatility and stress. Time is your greatest ally. The earlier you start, the less you need to invest each month to reach your goals. Thanks to compound interest, a 25-year-old investing $300 per month could end up with more than a 35-year-old investing $600 per month, simply because of the extra decade of growth. Do not wait until you have more money. Start now, even with small amounts. Consistency beats size. Finally, accept that you will make mistakes. Everyone does, even professionals. You will buy high. You will sell low. You will chase trends. The key is not perfection. It is learning, adjusting, and staying in the game. Document your decisions. Review them quarterly. Celebrate progress, not just profits. Investing is a lifelong skill, not a one-time event. Welcome to the journey. Let us cut through the noise. There are only a handful of core asset classes every beginner must understand: stocks, bonds, real estate, cash equivalents, and alternatives. Each behaves differently under economic conditions, carries unique risks, and serves specific purposes in a portfolio. You do not need to invest in all of them immediately, but you must understand what they are and how they work before allocating a single dollar. Stocks represent ownership in a company. When you buy a share, you own a tiny piece of that business. Stocks offer the highest long-term growth potential but come with high volatility. Prices swing daily based on earnings, news, interest rates, and investor sentiment. Beginners should focus on broad market index funds like S&P 500 ETFs. Rather than individual stocks, you get instant diversification and lower risk. Bonds are loans you give to governments or corporations in exchange for regular interest payments. They are generally safer than stocks and provide steady income, making them ideal for conservative investors or those nearing retirement. But do not assume safe means no risk. Interest rate changes, inflation, and default risk can still impact bond values. Understand duration and credit quality before buying. Real estate can mean physical property, rental homes, commercial buildings, or paper exposure, REITs, real estate investment trusts. It offers income through rent or dividends and potential appreciation. But it is illiquid, requires management unless you use REITs, and is sensitive to interest rates and local markets. For beginners, REITs traded on stock exchanges are the most accessible entry point. Cash equivalents include savings accounts, money market funds, CDs, and short-term government securities. They offer safety and liquidity but minimal returns, often below inflation. Their role is not growth. It is preservation and emergency access. Keep 3 to 6 months of expenses here. Do not chase yield in this category, chase security. Alternative assets include commodities, gold, oil, cryptocurrencies, private equity, hedge funds, and collectibles. These are speculative, complex, and often unregulated. For beginners, avoid them until you have mastered the core 4: stocks, bonds, real estate, cash. Crypto especially is not investing. It is high-risk speculation. Treat it like gambling money, not retirement money. Asset allocation is how you divide your money among these classes. A 25-year-old might do 80% stocks, 15% bonds, 5% cash. A 60-year-old might reverse that. Your allocation should match your risk tolerance, time horizon, and goals, not what is trending on TikTok. Rebalance annually to maintain your target mix. Drift too far and you expose yourself to unintended risk. Geographic diversification matters too. Do not put everything in your home country. The United States market is not the only game. Emerging markets, Europe and Asia offer growth opportunities and act as hedges when your domestic market struggles. Global index funds like VT or ACWI make this easy. Even 10 to 20% international exposure reduces concentration risk. Sector diversification prevents overexposure to one industry. Tech stocks might boom today, but regulations, competition, or innovation shifts can crush them tomorrow. Balance your equity exposure across healthcare, consumer staples, financials, industrials, and utilities. Again, broad index funds handle this automatically, another reason they are perfect for beginners. Finally, understand that no asset class is always safe or always profitable. Bonds crashed in 2022. Tech stocks plunged in 2021. Real estate bubbles burst. Cash loses value to inflation. The only constant is change. Your job is not to predict the future. It is to build a resilient, diversified portfolio that can weather any storm. That is how real investors survive and thrive. The investment world is overwhelming thousands of stocks, funds, platforms, and strategies. But as a beginner, your goal is not to master everything. It is to start simple, stay consistent, and avoid catastrophic mistakes. Your first portfolio should have no more than 3 to 5 holdings. Complexity is the enemy of clarity, and beginners need clarity above all else. Start with a total stock market index fund or S&P 500 ETF. Examples: VTI, VOO, or SPY. These funds hold hundreds or thousands of companies, giving you instant diversification, low fees, and market-matching returns. You do not need to pick winners, you just need to own the entire market. Historically, this approach beats 80% plus of professional fund managers over time. Add a total bond market fund for stability. Examples: BND or AGG. This smooths out volatility and provides income. Even if you are young and aggressive, having 10 to 20% in bonds reduces emotional stress during downturns, which helps you stay invested instead of selling at the worst time. Bonds are not boring. They are your portfolio's shock absorbers. Consider a global stock fund for international exposure. Example: VXUS or IXUS. The United States is only about 60% of the global market. Owning international stocks hedges against United States-specific risks and taps into growth in Asia, Europe, and emerging economies. You do not need to pick countries. A broad fund does it for you. If you want real estate exposure without buying property, use a REIT ETF. Example: VNQ or SCHH. These trade like stocks but hold income-generating properties. They offer dividends and diversification but can be volatile. Limit to 5 to 10% of your portfolio unless you have specific expertise or goals tied to real estate. Avoid individual stocks until you have mastered the basics. Yes, it is tempting to buy Apple, Amazon, or Nvidia, but one stock can drop 50% overnight due to earnings, lawsuits, or leadership changes. Index funds cannot go to zero. They recover. They grow. They compound. Let them do the heavy lifting while you learn. Never invest in something you do not understand. If you cannot explain how an asset works, why it has value, and what risks it carries in simple terms, do not buy it. This rule eliminates 90% of hot tips, crypto projects, meme stocks, and complex derivatives. Simplicity is not weakness, it is wisdom. Compare fees relentlessly. Expense ratios, trading commissions, account minimums, and hidden costs add up. A fund charging 0.03% versus 1% might seem trivial, but over 30 years, that difference could cost you half your returns. Use platforms like Vanguard, Fidelity, or Schwab that offer $0 commissions and ultra-low-cost funds. Automate everything. Set up automatic contributions from your paycheck or bank account. Schedule automatic purchases, dollar-cost averaging. Enable automatic dividend reinvestment. Remove emotion and forgetfulness from the equation. Consistency, not timing, is what builds wealth. Let systems work for you. Review but do not obsess. Check your portfolio quarterly, not daily. Ignore short-term noise. Do not chase performance. Rebalance once a year to maintain your target allocation. The less you tinker, the better your results. Great investing is 90% discipline, 10% strategy. Start simple. Stay the course. Let time do the rest. Choosing where to invest is as important as what you invest in. A bad platform can drain your returns with fees, limit your options, or frustrate you with poor tools. As a beginner, prioritize low or no fees, user-friendly interface, educational resources, and access to core assets, ETFs, index funds, bonds. Avoid platforms pushing crypto, options, or day trading to new users. Top beginner-friendly brokerages: Fidelity, Vanguard, Charles Schwab. All offer $0 commissions, no account minimums, fractional shares, and access to thousands of low-cost ETFs and mutual funds. They are regulated, stable, and designed for long-term investors, not gamblers. Avoid apps that feel like casinos looking at you, Robinhood, until you are experienced. Understand account types. A taxable brokerage account is flexible. You can withdraw anytime, but you will pay taxes on gains and dividends. Retirement accounts, like IRAs in the United States, offer tax advantages but restrict early withdrawals. Choose based on your goals. Taxable for medium-term goals, retirement accounts for long-term wealth building. If you are employed, check if your company offers a 401k with matching contributions. This is free money. Always contribute enough to get the full match. It is an instant 100% return. After that, fund an IRA, Roth, or traditional for additional tax benefits. Max these out before investing heavily in taxable accounts. Roth versus traditional IRA. Roth is usually better for beginners. You pay taxes now, but withdrawals in retirement are tax-free, and you can pull out contributions, not gains, penalty-free if needed. Traditional defers taxes now but taxes you later. If you are young and in a low tax bracket, Roth is almost always the smarter play. Fractional shares are a game changer. You do not need $400 to buy one Amazon share. You can buy $5 worth. This lets you build a diversified portfolio with small amounts. Use this feature to spread your money across multiple asset classes even if you are starting with $100. Consistency is greater than size. Enable dividend reinvestment, DRIP. This automatically uses dividends to buy more shares, compounding your growth without lifting a finger. It is free, effortless, and accelerates wealth building. Never take dividends as cash unless you need the income. Reinvest them to fuel long-term growth. Security matters. Use two-factor authentication. Never share login details. Monitor account activity. Choose brokerages with SIPC insurance, up to $500,000 protection. Your money should be safe even if the platform fails. Do not chase higher yields on unregulated platforms. Safety first. Use the platform's tools but do not over-rely on them. Screeners, charts, and news feeds are helpful for research, but they can also fuel obsession and overtrading. Set alerts for rebalancing or contributions, then log out. The best investors spend the least time staring at their portfolios. Finally, do not switch platforms often. Transferring accounts is a hassle, and chasing better features usually costs more in time, taxes, and fees than it gains. Pick a solid, low-cost provider and stick with it for years. Platform loyalty is not sexy, but it is profitable. Build your system, then let it run. Risk is not just losing money, it is misunderstanding what you are exposed to. Market risk, inflation risk, liquidity risk, geopolitical risk, behavioral risk. Each requires different management. Most beginners only think about price drops. Real investors prepare for all risks and build portfolios that can withstand them. Volatility is normal. The S&P 500 has a 14% average annual swing. Some years it drops 30%. Others, it jumps 30%. If that terrifies you, you are overexposed to stocks. Adjust your allocation. Add bonds. Reduce risk. Do not fight the market. Align your portfolio with your emotional capacity. Survival is greater than optimization. Loss aversion is your biggest enemy. Studies show people feel the pain of loss twice as strongly as the joy of gain. This leads to selling low and buying high, the exact opposite of investing. Train yourself to see downturns as buying opportunities, not disasters. Market drops are sales, not fires. FOMO, fear of missing out, destroys portfolios. When everyone is buying crypto or AI stocks, resist the urge to jump in. Bubbles always burst. By the time it is on the news, it is too late. Stick to your plan. Let others chase hype. You chase consistency. Boring beats exciting every time. Confirmation bias makes you seek information that supports your choices and ignore warnings. If you bought a stock, you will only read bullish articles. Fight this. Seek opposing views. Challenge your assumptions. The best investors are their own worst critics before the market is. Recency bias tricks you into thinking recent trends will continue. Stocks went up last year. They will keep rising. Nope. Markets revert to the mean. Past performance does not equal future results. Base decisions on fundamentals and valuations, not momentum. History does not repeat, but it often rhymes. Overconfidence kills. After a few wins, beginners think they are geniuses. Then the market humbles them. Stay humble. Assume you know less than you think. Keep learning. Track your performance honestly. If you are beating the market, ask, is it skill or luck? Usually it is luck. Create rules and follow them. I will only invest in assets I understand. I will never put more than 5% in one stock. I will rebalance annually. I will not check my portfolio daily. Write them down. Tape them to your monitor. Rules override emotions, and emotions override logic. Practice detachment. Your portfolio is not your identity. A bad quarter does not mean you are a failure. A good year does not make you a guru. Separate your self-worth from your net worth. This mental shift reduces stress and improves decision-making. You are not your investments. Finally, build margin of safety. Do not invest money you cannot afford to lose. Keep emergency cash. Avoid leverage borrowing to invest. Sleep should never be lost over market moves. If investing causes anxiety, you are doing it wrong. Scale back. Simplify. Rebuild confidence slowly. Emotional control is not optional. It is the core skill of investing. Taxes are inevitable, but you can control how much they take. In taxable accounts, you will pay capital gains tax when you sell for a profit and income tax on dividends. Short-term gains, held less than 1 year, are taxed as ordinary income. Long-term gains, greater than 1 year, get lower rates. Hold longer. Pay less. Tax-advantaged accounts are your best friends. IRAs, 401ks, HSAs, these defer or eliminate taxes on growth. Max them out before investing in taxable accounts. A dollar saved in taxes is a dollar earned, and it compounds. Prioritize these accounts like your financial future depends on it. Because it does. Tax loss harvesting is a powerful tool. If an investment drops in value, you can sell it to realize a loss, offset gains, and reduce your tax bill. Then reinvest in a similar, not identical, asset to stay in the market. It is legal, smart, and used by pros. Learn it. Use it. Save thousands. Fees are silent killers. A 1% annual fee does not sound like much, but on a $100,000 portfolio, that is $1,000 per year. Over 30 years, $30,000 plus, and that is before compounding. Choose funds with expense ratios under 0.10%. Avoid advisors charging 1% AUM unless they provide exceptional, personalized value. Trading commissions still exist on some platforms. Avoid them. Use brokers with $0 stock or ETF trades. Also watch for mutual fund transaction fees, wire transfer fees, and inactivity fees. Read the fine print. Small fees add up to big leaks. Bid-ask spreads matter, especially for low-volume assets. The difference between what buyers will pay and sellers will accept is a hidden cost. Stick to highly liquid ETFs, high trading volume, to minimize this. Illiquid assets cost more to enter and exit. Avoid them as a beginner. Turnover ratio in funds indicates how often holdings are bought or sold. High turnover equals more trading equals more capital gains distributions equals more taxes for you, even in funds you did not sell. Index funds have low turnover. Actively managed funds often have high turnover. Choose wisely. Dividend taxes vary. Qualified dividends from United States stocks held long enough get lower tax rates. Non-qualified REITs, some foreign stocks, are taxed as ordinary income. Structure your portfolio accordingly. Hold tax-inefficient assets like REITs in retirement accounts where possible. Rebalancing triggers taxes in taxable accounts. Selling winners to buy losers creates taxable gains. Do it sparingly, annually is enough. Or rebalance by directing new contributions instead of selling existing holdings. Minimize taxable events. Every trade has a cost. Finally, audit your costs annually. List every fee, tax, and expense tied to your investments. Compare to benchmarks. Are you paying more than 0.20% in total costs? You are probably overpaying. Trim fat. Switch funds. Change platforms if needed. Efficiency is not glamorous, but it is how fortunes are quietly built. Your portfolio is not a set-it-and-forget-it machine. It is a living system that needs occasional maintenance. But occasional is key. Over-managing destroys returns. Under-managing invites drift. Find the balance. Review quarterly, rebalance annually. Adjust strategy only when life goals change. Start with a simple allocation. 80% stocks, 60% United States, 20% international, 15% bonds, 5% cash. Adjust based on age, goals, and risk tolerance. Younger? More stocks. Nearing retirement? More bonds. No perfect mix exists, only what is right for you. Write it down. Stick to it. Rebalancing restores your target allocation. If stocks surge and now represent 90% of your portfolio versus 80% target, sell some stocks and buy bonds to rebalance. This forces you to sell high, buy low. The golden rule. Do it once a year. Automate it if your platform allows. Use new contributions to rebalance, not just selling. Instead of selling winners, direct new money into underweight assets. This avoids triggering taxes in taxable accounts and keeps you invested. Simple, smart, and efficient. Increase contributions over time. Got a raise? Put half into lifestyle, half into investments. Automate this. Small increases compound massively. A 3% annual bump in contributions can double your final portfolio versus static contributions, even with the same returns. Avoid chasing performance. Last year's top fund is rarely next year's winner. Rotate into hot assets and you will buy high, sell low. Stay diversified. Stick to your plan. Let rebalancing handle shifts, not headlines. As you age, gradually shift toward safety. At 25, 90% stocks. At 45, 70%. At 65, 40%. This glide path reduces risk as your time horizon shrinks. Use target date funds if you want this automated or adjust manually. Do not stay aggressive too long. One big crash near retirement can wipe out decades. Track progress, not daily value. Measure against goals. Am I on track to hit $500,000 by 40? Use compound interest calculators. Adjust contributions or risk if you are falling behind. Ignore short-term noise. Focus on the long arc. Document every decision. Why you bought. Why you sold. What you learned. Review annually. This builds self-awareness and prevents repeating mistakes. Great investors are not lucky, they are reflective. Finally, scale with confidence, not ego. As your portfolio grows, do not get fancy. Do not start picking stocks or trading options. Stay simple. Stay diversified. Stay disciplined. Complexity does not increase returns, it increases risk. The richest investors often have the simplest portfolios. Master the basics, then keep mastering them. The market will test you. Crashes, corrections, bear markets, headlines screaming, sell everything. Your job is not to predict them, it is to survive them. History shows every crash was followed by recovery and new highs. Panic sells. Patience profits. Stay the course. Ignore financial media. They profit from fear and frenzy, not your success. Turn off CNBC. Mute finance Twitter. Delete investing apps that send push notifications. Noise creates bad decisions. Silence creates clarity. Invest in peace, not panic. Beware of scams. Guaranteed returns. Secret strategies. Insider tips. If it sounds too good to be true, it is. Legitimate investing has no secrets, no guarantees, and no urgency. Scammers prey on greed and insecurity. Protect yourself. Verify credentials. Check SEC filings, and never invest under pressure. Avoid gurus, selling courses, newsletters, or stock picks. Most have no verifiable track record. Many profit from your subscription, not your success. If they were so good, why are they selling advice instead of quietly getting richer? Real experts teach principles, not picks. Do not compare yourself to others. Your neighbor's portfolio is not your benchmark. Social media is highlight reels, not reality. Focus on your goals, your timeline, your progress. Comparison is the thief of joy and returns. Celebrate milestones, not just money. First $1,000 invested. First year of consistent contributions. First 10% return. First rebalance. These are victories. They build confidence and habit. Wealth is built in small steps, acknowledge them. Keep learning but filter wisely. Read books by Bogle, Malkiel, Bernstein. Follow credible educators, not influencers. Avoid get-rich-quick content. Depth beats hype. One great book is worth 100 viral videos. Teach others. Explaining investing to a friend solidifies your knowledge. It also builds accountability. Share your journey without giving advice. You will learn more by teaching than by consuming. Now it is your turn. You have the knowledge. You have the plan. You have the tools. All that is left is action. Open the account. Buy the first fund. Set the automatic contribution. Take the first step today. Not tomorrow. Not when I know more. Now, momentum starts with motion. If the script helped you cut through the confusion and see investing clearly, do 3 things right now. Like this video, it tells YouTube this content matters. Subscribe, you will get more no BS financial education every week. Comment, I am starting today. Hold yourself accountable. We will cheer you on. And if you found value, share this with one friend who is also afraid to start. Investing is not about being smart. It is about being consistent. You have got this. Now go build your future.